Hey everyone, welcome back to my channel. It's Nasdaq with Arshia. Today we're going to be talking about the second correction day. Treasury yields are dipping, stocks are gaining, and people are reacting insanely to the Fed's minutes ahead of time. Before we begin, I want to say I'm not a financial advisor and you should always do your own due diligence and research before taking part in any investment scheme. Let's get into it. All right. So here I've got my screen shared with you guys. So the first things first, stock market news live updates. Nasdaq sinks by 1.2%. Tech route extends. I just want to give you guys a viewpoint on the Nasdaq composite. It's an absolute bloodbath, just like yesterday. So what is happening? So stocks are gaining, and people are having a mixed reaction. And some are just keep buying because they know it's going to be over. Some sell because they're in utter panic mode. So bond yields dip. They're on their all-time low since November, and oil prices rise due to inflation. And people are reacting to the Fed's minutes ahead of time because the first interest rate hike is apparently very near. So let's get started with the first one. Let's get started with the first concern, treasury yields. So treasury yields gave back some recent gains, and the benchmark 10-year yield retreated after nearing 1.9% a day earlier for its highest level since January 2020. Commodity prices rose further, and the U.S. West Texas Intermediate crude oil futures, basically just crude oil futures in a nutshell, it rose above $86 per barrel and its highest level since 2014. So according to many strategists, the recent volatility across all risk assets has greatly reflected investors' ongoing perspective and reassessment of like pricey asset prices, with interest rates hiking and liquidity out of the Federal Reserve just looming everywhere. People are now starting to reassess everything, and the market is actually a reflection of that. And though Fed officials are on like a blackout period before the next meeting next week, policymakers over the past few weeks have telegraphed that they're gearing up to raise interest rates and eventually draw down the nearly $9 trillion on the Fed's balance sheet as the economy recovery continues and inflation soars. And I think that at this point, it's really clear that the first interest rate hike will be at the March meeting. And I think it's definitely a repositioning of the market to deal with what really the Fed has done. And I actually have a quote from Citibank that sums this up. Let me just show you guys. So David Bailing, Citi Global Wealth Chief Investment Officer, says, and the Fed has basically created some certainty around the fact that there will be rate rises. Then the question is, how much do they actually release from their portfolio? And it's that creates their enormous uncertainty. And that, in a nutshell, is one of the reasons why the market is going up, down, up, down, up, down, just like a seesaw. And it's driving me nuts, but we got to hold on. So anyway, to sum up 2022 so far in the stock market, the tech-heavy index NASDAQ is off to a terrible start, down about 8.3%, closing out Wednesday down 1.2% at $14,340.26, putting it about 10.7% below its November 19th record peak and meeting the common definition for a correction in asset's value. Also, there's one thing I wanted to show you guys. Since 1971, the NASDAQ has logged 65 or 60 corrections. The NASDAQ composite just logged its 66 corrections since 1971. Here's what history says next. What happens next? Well, there's one thing that I like to quote from a book called The Intelligent Investor by Benjamin Graham. This is the book right here. And at the very beginning, this dude says, the market will fluctuate. It's in human nature to buy and sell and speculate. And so the market will fluctuate. This is normal. It'll go up and down. You can't expect it to stay at one place. So the index has registered a correction as defined 65 times since its first launch in 1971, and 24 of them have resulted in bear markets or declines of at least 20% from a recent peak. 24 out of 65 or 37%. So it's very, very unlikely that we're gonna have an entire bear market. So in conclusion, there's nothing to worry about, nothing at all. And this is just a correction and reaction to the Fed's normal shenanigans. So thank you guys for watching this video. I hope you enjoyed this video. If you found this information helpful, please be sure to like, comment, and subscribe. Comment moonshot so I know that you're with me at the end of this video. Thank you guys so much and see you in the next video. Bye-bye.